Welcome back to Markets Mindset, everybody. I'm Victor Forte. I'm here with Moshe Tomkiewicz, head of debt capital markets here at Mizuho, and Colby Griffith, head of U.S. debt syndicate. And a happy new year to everybody. Happy new year to both of you, belatedly by a little bit. Well, guys, we have a lot to talk about since we last got together, Moshe and I at least. You know, we left last year with a big issuance of tech bonds that kind of put the market a little bit on notice. Things got a little wobbly, but all of a sudden we walk in after 2-3 weeks down in December of no issuance, and it looks like the market's just got back to basics. I mean, we're sitting here with 90 billion of supply over the 3 days that have just passed, first 3 days of the year, setting some records. I know, Colby, you're going to talk to us about that. But it feels like the market's taken it completely in stride. 4+ times over subscriptions, 3-4 basis points of new issue concession, attrition rates on moves from IPT to final price, you know, relatively holding at averages for all of last year. Colby, what do you make of this here as we open up and have, you know, 3 of the biggest days that we've ever had back to back to back?
Well, I think on one hand, it's not all that surprising. I think all the commentary and the conversations that we had both with issuers and investors during the month of December was all about the supply that we're going to see not only in January, but for all of 2026. You look at the estimates for this year and they are, you know, above normal numbers. If we do hit some of the estimates out there, they will be record years for our market.
But let's talk about that. So 1.65 trillion last year. And I think the ranges for many of the banks in the street ranged from flat to north of 2 trillion.
Correct.
And where's that coming from?
So a couple of things are going to drive that. You know, our number is right kind of in the middle of that. We're right around a 1.85, 1.86 trillion number, which would still be a pretty sizable increase versus last year. For us, there's a couple of primary drivers. One is obviously going to be the data center supply and broader tech supply that you alluded to. That theme is going to continue from last year and into this year. The other big factor is going to be, at least that we think, is going to be M&A.
180 billion last year.
I think we're going to see something certainly with the 2 handle, probably closer to the mid 2s. Why is that? Last year, people had very high expectations for M&A as well. Obviously, the first quarter that got a little bit disrupted with the noise around tariffs. This year, it seems to be a much more clean type of a calendar from that perspective as far as a geopolitical standpoint, I guess. So we think that will increase. On the financial side, so we think most of the driver will be corporates. On the financial side, we're expecting a lot more of the same. The one sector we do think that could increase is likely Yankee banks.
And so, Moshe, turning it over to you, we walk into this year, Moshe, right? And we talked about this, these 3 days of supply, epic supply, and yet the market has taken it relatively in stride. What are the things that you're looking at going forward that maybe people should be more concerned about as we head here into 2026 that don't seem to be reflected in how they absorb the new issue supply here over the last 3 days?
The way I look at it right now is what we're seeing in the broader market is an ever-increasing bet on productivity growth. Because the narrative in the market right now is we have an economy that's growing above trend. We're in the midst of getting a healthy dose of both fiscal and monetary stimulus. And at the same time, the bond market, it continues to play ball. 10-year yields have traded between 4 and 4.20 since early September. Market feeds off of that lack of volatility. So the narrative of non-inflationary growth is a big one right now. And so I think the main test for the market is, are we able to deliver on the productivity growth the market is currently assuming? And how are we going to see that? Well, right now, what we're seeing is a rotation out of the Mag 7 into everybody else. And that everybody else is basically a call on efficiencies and growth going forward. So what we're going to want to hear during earnings is an uptick in companies using AI, an uptick in companies claiming efficiencies on AI. If we do see that, then this narrative is going to continue, and that's going to be very bullish for risk.
So how much of the rush to the market you think is from issuers looking to get ahead of what we all know is a big earnings season at the end of January, beginning of February, for most of the major tech companies, where whether it's on their earnings call, they're going to be announcing their needs, their CapEx needs, and whether those are going to go up or not, because we've seen what's happened in the past to bond spreads for certain issuers when you see them announce ever increasing CapEx needs. But also, if there is issuance on the other side of that, it can be very large. You think a lot of what's driving the issuance now in these first possibly 2 weeks is from people looking to get ahead of that inflection point?
100%. I mean, if you think about what debt capital market officers have been doing for the last 3 months, is we've been crying wolf on all the supply that's coming in 26. Well, guess what? Investors have been hearing that same story, and they're positioned for it, and yet markets trading tighter in the face of record supply. That's market code for we're ready for that supply. As long as we continue to see this volatility backdrop that we're seeing today, we're ready for it and we're willing to take it.
And Colby, so I remember in the fourth quarter, we all were concerned about this big tech supply and spreads widening out. But when we stripped away the issuance, the tech issuance from those companies, spreads in most of the other categories really didn't widen out. And are you thinking that's the same thing that's going to happen here? Do you think that the other industries, other sectors will be able to glide through a heavy issuance window from the tech companies once again and kind of have the tech be offset by itself?
Well, I mean, if you look at, to Moshe's point, if you look at what has come this week as kind of a barometer of that, right? Because the names that have come this week should be no surprise to anyone. There's, of the quote unquote frequent flyers, if you will, that always come the first week in January, we've hit on about 17 or 18 of them. There's only a handful of them that have not come yet. And so it's a lot of the names that people expected to come, a lot of the sectors that people expected to come, right? If you look at the supply that has come, of that 90 billion or so, about 55 of it is either from Yankee banks or from the auto space. Those are two of the biggest users of that first week every single year. So the market got that other supply that it was expecting, right? The non-tech supply that it was expecting. And it got it in pretty good size, right? As you alluded to earlier, we're, the biggest week we've ever had in the first week. We're fourth all time right now as it sits today, with, I guess, an outside chance of getting to third for total week size. And to your point, concessions were very minimal. And so I think that is a pretty good, insight into what I hope will be the response, or could be the response from investors, as they start getting hit with some of the other kind of quote unquote tech or data center supply.
I mean, you have to consider though that you've had 90 billion of supply in 3 days. At some point, when do you outpace the natural demand of the market and it starts to weigh on spreads at some point?
That is absolutely the risk, right? And so, to your point, we had an earlier end to the year this year, from last year, with the Fed being slightly earlier than it traditionally is. So we really had 3 or 4 weeks basically of no supply. If we continue to run at this historic pace, it is going to have to weigh on spreads, right? I think this first week, certainly it was benefited from being there early and taking advantage of that kind of lax of supply over the last 4 weeks. I think as it continues and as it kind of grows longer, if you will, from a streak perspective, that's where I think the risk for not only spreads widening, but concessions growing really start to kind of come into the market. If that brings us toward the data center supply, that probably is the biggest risk out there.
This is really for both of you, because maybe you look at it in a different way, but we talked last year about the longer dated bid that was in the market. Right, it was a very strong bid through most of the year for long dated paper. That waned a little bit in the fourth quarter because we upped the ante. We were averaging relatively de minimis numbers of long bonds, 20 years and longer, being issued on a weekly basis. And all of a sudden, at a point in the fourth quarter last year, we upped that pretty heavy. And that weighed on the market a little bit. We saw long end spreads give it up. Long end spreads have come back in, yet, again, it's a small sampling of 3 days. Last year, we were, Colby, 8% was roughly 20 years and longer.
Point,
And now we're at 10%, 20 years and longer. How do you feel about the long bond bid here and the desire of issuers to go after it in a steepening market right now?
Let's start with the bid. I think as long as rates stay in a very tight range and you have kind of generational low volatility, you're going to have people reaching out the curve to maximize yield on the demand side. And I think as that basis versus the rest of the curve comes in, I think you're going to entice more issuers out the curve, especially that they feel that the rate backdrop that we're looking at right now is more likely the one going forward.
You don't think there's going to be, or maybe I'll ask Colby, you don't think there's going to be pushback from issuers, because we have seen there has been a decent steepening during the month of December heading into today, and obviously spreads haven't tightened enough on 10s, 30s to make that up. It's gotten more expensive to go out the curve, and we always see issuers who don't want to add extra let's just say they don't want to have the cost or the earnings per share, the debt weigh on the earnings per share. Do you think that that's going to hold them back from issuing out the curve?
I mean, Moshe can't answer from an issuer perspective, but I think a couple of things that we've seen over this week, and again, it's only 3 days of issuance, right? So it's pretty hard to take too many kind of big themes out of it. But a couple of things I've seen is, one, we've seen 5-year issuance increase, probably the biggest change on the corporate side, right? So it's increased 10% versus where it was at this point last year. Now, it's all about the same amount of issuers as far as the issuers that are names that are there, but they have chosen to use more 5 years versus 10 years from a historical perspective. So you have seen some issuers maybe shorten up from that standpoint. Further out the curve, we haven't seen much of it yet, to your point. Part of that has to do with who's in the market in that first week of the year, right? As I mentioned, it's a lot of financials, it's a lot of autos, a handful of utilities that they will use the long end of the curve. I think that'll remain still to be tested as we get kind of further into January. In early February, when we see more of a, I guess, pure corporate type of a calendar.
What I was going to add is keep in mind that since the Fed started raising rates in 2022, people have been biased for shorter rather than longer from an issuance perspective. You add that on top of all the COVID maturities that we're seeing this year and the next year and the year after that, that really starts stacking up. So you're going to see issuers being pushed out the curve out of somewhat necessity, just given how much they've been relying on the front end. Now, that doesn't necessarily translate into dollar supply. Your multinationals may look at a bunch of different currencies, just given the nominal differential in coupons. But again, I think if you're looking at this current rate backdrop and that holds, I think you're going to see some extension going out the curve.
And yeah, I mean, and Moshe, from your standpoint, you've done a lot of work with issuers going into Europe. Europe's a different factor nowadays as it was even 2 years ago, right? Europe is deeper, it's stronger, it's larger. The rates in some cases, or the swapped equivalent rates in some cases, are better than what we're able to issue in the States. How much of a factor do you think that's going to be on our supply this year going forward? And do you think numbers that are 1.85 trillion take into account the idea that we could have a lot of supply going into Europe if people have either the net interest hedging availability or are willing to do the swap back to dollars?
Yeah, I think when we look at our business right now, in terms of our book of business, probably have the most amount of euro mandates lined up at this point in my career than I've seen. And it all goes back to what you're talking about. And I think there's two things going on in Europe. One is just a nominal lower cost of funding for people who have net investment hedging capacity. And I think two is, concerned about crowding out of the U.S., just given tech and M&A supply. Let's hit that diversification lever and hit a market that's not seeing that level of paper.
I'm going to try to end this on something that I think would be great to do collectively between the two of you so we cover all the bases. And I'm going to start with you, Colby. But What are the things that you look forward over the next few months to say, these are the seminal events, and if they don't turn out the way the market's feeling about it right now, this is going to make a change in things?
It's a tough question. I feel like right now, to be fair, I think the market has a much better handle on kind of the events that are coming up, right? I think part of the issue was the fourth quarter that we saw and the impact that it had on spreads was that data center supply kind of caught the market a little bit off guard. That topic is no longer a surprise to anyone.
So does that mean it could be a surprise to the upside if it doesn't materialize, or if it goes to Europe, or if it just...
From some extent, yeah, I think that could be an upside. Now, will that happen? We don't know.
Right.
It feels like that will be a couple of weeks away still. That would have been a concern, but I think the market's in a pretty good spot there. It feels like from a Fed perspective, the market is not expecting too much from the Fed too soon. So I think that is in a better spot than maybe where we were a month ago.
So more likely any change would be a higher expectation of Fed eases or sooner than what they currently are, which is you don't get to a full probability of a Fed ease until June now at this moment.
So I think those are things that would have been an issues that have kind of settled themselves out. I think the big question is going to be if other issuance continues at the rate it is right now. I think everyone, when they were looking at their projections for 2026, as I said, it was all about data center supply and it was all about M&A. If other sectors that people weren't expecting become much larger, that could be something that pushes on spreads.
Same thing to you, Moshe. Any other things that you're concerned about that you're telling your clients to look out for and just keep an eye on, or have in their thoughts around timing as they look at the markets over the next 3-4 months?
My two main things are inflation and AI implementation. All right. So when you have a non-inflationary growth narrative in the market, these two things matter, right? What are we seeing on the inflationary front in terms of pricing pressures? As importantly, what are we seeing in terms of AI implementation to give us a better crystal ball in terms of future efficiencies? So to me, those are the two most important things aside from obviously earnings and any geopolitical events.
And the last thing I'll leave you with both. So do the midterms matter? We have so many other things going on. I usually know in this time of year, we start to worry that the midterms start to have an effect on the markets because of the ambiguity between will we have full government one way or will we have split government? Who will be the Fed chair, et cetera? Where do you put those kinds of things into the mix of things you're looking at? Or do you not care about them right now?
I think the market already assumes that the Supreme Court is going to strike down tariffs. And I think the market already assumes that we're going to get a very accommodative Fed chair. So I think those obviously matter, but I think the market is already assuming the stuff that normally creates volatility.
Well, that'll be it for this session. Thanks again for tuning into Markets Mindset. Gentlemen, thank you very much. And we look forward again to seeing you next time. And again, Happy New Year.